Welcome to the Retiring Real Estate Investor podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello, everyone, and welcome to the Retiring Real Estate Investor podcast. I'm your host, Brandon Bruckman. I am joined by our guest, Brandon Burns. Do not be confused. 2 double B's. Just as Brandon Burns, but just shout Brandon. One of us will answer. So Brandon, thank you so much for joining us. Awesome background from Brandon. I'm going to let him share with you. He's on the 1031 exchange qualified intermediary side, but his background is, I think, very unique for the space and super applicable. So Brandon, again, thank you for joining us. Why don't you introduce yourself to our audience, tell them kind of where you're coming from, and sort of how you got into this space.
Yeah. Thanks for the opportunity, man. Again, Brandon Burns. So both of us are double B's. I think B is a great letter, so it's working out really well.
Into it too.
Sometimes I joke and say I'm related to the old yellow man on The Simpsons, although full disclosure, that's not the case. I'm grateful to be in the 1031 space as a qualified intermediary rather than being a part of the nuclear energy power things like the yellow Mr. Burns and The Simpsons. But I really enjoy being in this space. And I think I do have a little bit of unique background. Most of the time, people are, kind of as they advance their career, they tend to go from high volume, low margin sectors to more specialty, higher margin, lower volume sectors. I'm probably one of the only people who's done the opposite. And I'm really grateful for that because it gives me a really unique background and experience where if someone is going through an exchange, I own properties. I've been a part of properties my whole career. I've spent 20 years really on the money side of real estate, with the past almost 6 years serving as a qualified intermediary. And what that helps me do a lot of times is understand where somebody's coming from and help come up with solutions, right? I also went in the space and got my certified exchange specialist designation, which is, the most technical designation you can have in my space, in the same way that a CPA is certified public accountant in the accounting space, or a certified financial planner in the financial planning space. I'm a certified exchange specialist. So, it's really fun to work through problems that people are facing and come up with solutions. And that's something that I really enjoy on a day-to-day basis. I would say most people that are in the space either started here or have a background in title or law. And it's fairly rare to have a fellow investor with a background in investing, kind of be alongside you as you go through the 1031 exchange journey.
No, it's awesome.
As a qualified intermediary, at least. Yeah.
I got excited because I have like 6 questions. Walk me through utilizing that background that you have as a real estate investor and having a tax background too. When someone hits your desk and potentially is looking at doing a 1031 exchange, how are you sort of helping them through that? I have a sneaking suspicion, because we see it on our desk too, you're going to be doing a lot more than just recording the transaction, moving money around.
Yeah, so I'd say 70% of what I do on a day-to-day basis is making sure people have the right data to make the right decision for themselves, right? One way that I'm very different from you, and I look up to what you do, is you're on the fiduciary side and helping people and guiding them through decisions, while my side of the business, the consulting and hand holding that I do here is more of an informative thing. So sometimes I don't get to see it all the way through. Sometimes I'm jealous of people in your shoes, Brandon. But it's really fun to be able to sit down. I was on a call before this, and the IRS looks at a couple of high level factors that are important to be aware of, right? And a lot of people know some of them, they don't know others. Like, for example, there's a time component, right? And most people know the time component. Once you sell, 2 clocks start, an identification clock of 45 days, and an exchange timeline clock of 180 days. But not as many people realize that you have to replace the value, right? So, as someone's going through this and trying to figure out what their their best solution is, like I said, I was just on a phone earlier with a lady who's selling 2 investment properties and she's looking to buy one, and just helping her understand, here's the important things to be aware of on timeline. From a value perspective, the IRS doesn't look at your basis, your debt, or your equity. They simply want you to replace the value minus the permissible closing costs, which are the cost of the people that worked on your sale. In California, that's the realtor commission, escrow, title, and 1031. And saying, okay, if you've got a couple of properties that you're selling, how do you line them up correctly so that you have different levers that you can potentially pull in order to make sure that either A, you don't have an unexpected tax bill, or B, if you're going to have a tax bill, you're well aware of it, and maybe can sit down with your financial advisor or CPA and try to mitigate some of that while you still have time, right? Because the worst kind of tax bill is when you have taxes on income that you didn't receive, and it tends to be a larger number, right? So that can happen in the 1031 exchange. That's called mortgage boot. So, because taking out or paying off a loan is not a taxable thing, then that's part of why the IRS doesn't look at, the capital stack. What's the loan? What's the equity? They just say, hey, you need to replace the value. And if you don't fully replace that, if you don't replace a loan, then that can be a significant tax bill. And it was an older lady closer to retirement, and she wasn't aware of that. And hopefully after the call, and I believe this is the case, she realized that if she doesn't fully replace the value, she's going to end up with around a $200,000 tax bill next April. And again, it's someone's money, right? So if she only wants to buy a little bit less value, that's where working with a good financial advisor or a good CPA to do a cost segregation, or to potentially invest in something that is has some strong tax benefits to offset, that can be really powerful. Because who wants to write a 6-figure check to the government, especially when you didn't receive any funds to do it with, right? So that's I think the worst kind of taxes.
They're all bad. But yeah, those are the worst ones, are when you don't have money to pay it and you really weren't expecting it. Becomes the worst ones. That kind of leads naturally into a question that I have. What are the most common mistakes that you see folks making, or misconceptions when they hit their desk? I mean, the replacement property has to be, or the replacement value versus your proceeds versus your gain has to be one of them. What are some of the others?
Yeah. So the replacement value is probably number one. Another one that I always try to highlight front and center is that if you change who's on title before or after the exchange is complete, the IRS has a paper trail to follow, right? So if you're going to notarize the deed, you're going to publicly file it with the county, there's a really clear trail for the IRS to follow. However, if you change the taxpayer that is on title in the middle of the exchange, for example, You sell under your personal name, you buy under an S corp, or you sell under a partnership, you buy under your personal name, and the sale and the buy show up on different tax returns, then the IRS is just going to, disallow the exchange. And so, that's another thing people don't think about, right? Especially people who are saying, hey, as I reposition my assets, I want to make sure that I have the right entities in place. And unfortunately, if you do it with the wrong timing, you can have really significant and drastic consequences. So I'd say the continuity of ownership is important, or how you hold title, the taxpayer that's on title. That's certainly something to be aware of, and something I try to highlight pretty consistently. Another thing that people get tied up on a lot is the identification. So, the IRS essentially wants someone to have a plan in place at some point within the first month and a half after selling their property. And so they have a couple of different identification limitations, right? So most people use the 3 property rule. In that scenario, the only limit is on the number of properties, max of 3. There's no other limits. You can, buy a property across state lines. You can buy 10, 10, any one of the 50 different states, kind of so on and so forth. There's no limitations except the number of what you identify. There's another identification rule that, instead of limiting you on the number of properties you identify, it limits you on the value. So, that's really good if somebody sells a larger asset and they want to diversify into 5 or 10 replacement properties. Or, you can also go into a Delaware statutory trust, which is, a fractional ownership. You can also go into a tenant in common structure, which is another, partnership structure. And so, you can go into a number of those. And if you want to go into more than 3, then you would want to use the 200% identification rule, which simply says you can identify an unlimited number of properties as long as their total value does not exceed double of what you sold. So, I had a client, and he sold a 3-plex in coastal San Diego, and he ended up buying 8 or 9 single family homes in Ohio, right? Because they cash flowed just so much better. And so, what he did is he took this great appreciation he'd been able to achieve the past 6-7 years, and he turned that into cash flow. I'm not sure that single family homes in Ohio are going to appreciate dramatically, but his income went up, I think, by 5 or 600%, right? So, one of the nice things about a 1031 exchange is it allows you to diversify, it allows you to reposition. I think one of the things that's true for real estate investors, I'd certainly include myself in this, is, I think the real estate market specifically, and private markets generally, tend to be efficient over the long term, right? So, however, they tend to be very inefficient in the short term. So you can go in and you can buy a property at a great value. You can buy a property that isn't positioned right. Maybe you've got tenants in there that are paying half of market rent. Maybe you buy a piece of land and you can build, a house on it. Maybe you can build a Starbucks on it, retail pad, whatever it might be. You can buy something and move it to its highest and best use. But then over time, it's going to be efficient. So one of the nice things about a 1031 exchange is it can allow you to either diversify, if you'd like, or reposition as times change, right? I think multifamily has been a really, really strong place to be. With the cost of debt going up, it's still a good place, but maybe not quite as strong as it once was. And so, I have a lot of clients that are looking around saying, hey, well, is self-storage a place where I can potentially get a little bit higher yield? Or, maybe looking at it, industrial warehouses, is that a better place? And not having to pay every time you make a change over time is so dramatic. When I was in business school, I remember really vividly, one of the few things that I remember from business school was I had a professor who talked about a mathematical principle called the geometric average. And not to dive into too much crazy math, but essentially, if you have $1 and you lose half and gain half, you're not at $1, right? You have $1, you lose half your 50 cents, gain half, now you're at 75 cents. So, if you have a 30%, tax hit, you really have to grow your money by 40% or more, sometimes 50%, just to get back to where you were. So when you mix that with compound interest, having a 1031 exchange where you can buy an asset, maximize its value over time, and then switch it either into diversified number of assets or into a different asset where you can, again, maximize the value and not have these kind of massive knife cuts in your equity bleed out over time with taxes. It can, again, just looking at some simple math, we're talking about wildly dramatic differences in your net worth over time.
And I would imagine the folks that, and we see them too, that hit our desk and are really asking us the question, should I exchange or pay the tax? And we're laying out this same, we'll pull the calculator out and we're laying out sort of the same math for them to say, here's what your return pattern needs to be in order for you to make up that gap. Here's what it can be if you do the exchange. You're like, oh, okay. And so a rough rule of average is, it seems to be over a 10-year period, you really need to double your return pattern to really make up for that 30% gap. So it's really visceral. And I just don't think that folks are aware of that or haven't really done the math to understand that. What do you think is driving that? The thought process of, should I do the exchange or not? Are you seeing folks that are in that same bucket where they're sort of asking that question of you guys as well? How do you typically respond?
Yeah, that's a great point, and that's so cool that you do that. I'm a math person at heart and super nerdy, and I don't think I've ever personally done that math. So that's really cool. So for a 1031 exchange, I think the most important thing for people to look at is opportunity cost, right? So, certainly there's times where people have said, hey, I've got some great equity in a investment property, but there's other parts of my financial life that could use some work, right? Maybe somebody has a significant amount of credit card debt, at a 25%, APR, right? That's just kind of eating at them. And so if someone, can invest in their business or pay off debt, especially expensive debt, then I think that conversation tends to be significant, and it's really important to weigh those options. However, if somebody's going to go back into real estate, the math is just wildly different, right? The cost of doing an exchange all in is less than $1,500, right? Yeah. So comparing that to 6-figure plus tax bills, I mean, like you said, that makes sense that it's so drastic. You have to double your return pattern. That it's wild to think about. That's really what it takes. Another thing that I think, as someone's looking at that, if they're not sure, essentially, when you do an exchange, you're not locked in to not paying taxes, or you can always decide to pay taxes if you want. So we charge $1,000 to set everything up and get it all through. So I tell people, I was on the phone with a just open exchange recently with a gentleman. He was selling a hotel that he'd owned for a really long time, and he wasn't really sure, kind of in that same situation. It's like, gosh, I know that I don't want to manage a hotel anymore. That I know for sure. Do I want to buy single family properties? Do I want to buy something triple net? Do I want to go buy a business? What's the next move for me in life, after owning and managing and running a hotel for 20 years? And so I told him, I said, if you don't do an exchange, which is perfectly fine, you're going to lock in that taxable event the day you sell. If you do an exchange, you're essentially paying $1,000 to buy a month and a half to figure out if it makes sense, right? Because it's someone's money. If they want their money, all they have to do is let us know. We send them a form, they send it back, and they have their money within 3 business days. So you're buying an option. Having that optionality can be really powerful, especially if you're looking at a $500,000 tax bill, saying, hey, I've got 45 days to maybe not pay that. And then worst case scenario, you pay the exact same tax you would otherwise, and you're out $1,000. But you had that optionality.
Couldn't agree more. How many exchangers are like our hotel friend that sort of hit your desk and they're like, here I am. I don't know what to do next. Do you find that a lot? And can you really tell our listeners why folks shouldn't do that and should maybe have a
Yeah.
different approach?
So I think 2 years ago, people were getting these wild and crazy offers, right? People were coming and saying, "Hey, I remember kind of vividly there was a gentleman that sold a multifamily in Houston, and he called me and said, "Hey, all right, the broker actually connected us, and he said, "Hey, I've got this in front of me. They're offering me 10 million. There's no way it's worth that much. I need to understand some tax things. I need to understand the 1031. Can we talk through that before I sign this?" And the broker's sitting there like, you know, uh, maybe I felt like he was about to, almost choke this guy. Like, if you don't think this is worth 10 million, what do you think it's worth? He's like, oh, like maybe 7 million. He's like, that's an extra reason for you to sign this offer before they change their mind, right? So, he said, so I think, specific to that example, but also in general, 2 years ago, people were saying, I'm getting these offers. I'm amazed. I'm blown away. I need to sign this and take that before someone changes their mind and comes to grip with reality.
Mm-hmm.
Right. I think we're in a different market today.
Mm-hmm.
So a lot of the conversations that I'm having today are people who want to get educated a little bit earlier in the process. So they're saying, hey, I'm thinking about listing. Hey, I'm thinking about taking this property to market. Hey, I've just listed this property. Let's start making sure we're really informed about timelines and other things that are important to know throughout the process. So I think overall that's good. It certainly can be scary to walk into a 45-day window, and if you can't find something you absolutely love, then you have a really significant tax bill. We're seeing more and more people doing reverse exchanges, where you buy something before selling what you have. The cost is a little bit higher on that. There's a lot more complexity. However, it does take the replacement risk off the table, because the timelines don't start when you sell. The timelines start when you buy. So that's something that's happening more. I guess it's a really long answer to your question. I think a short answer might be, maybe a third of people 2 years ago were walking into a sale and then trying to figure out what to do. Today, that number is a lot closer to 10 or 15%. So it's down pretty dramatically.
Oh, that's good. That's good. We just don't want people to be in that situation, because it's stressful and the 45 days go fast. You remind me of a good point that I don't get into a lot just because of the nature of my business. But can you go through reverse exchanges in detail? Folks ask me about this all the time. I give them the basics, but give them like layer 2 and 3 of what that process looks like.
Yeah, I can absolutely do that. And it happens so often. I have someone on staff that just focuses on the reverse exchanges.
Oh, wow. Okay.
She's fantastic. So one of the fundamental rules for a 1031 exchange is you can't 1031 exchange into a property you already own. Essentially, the IRS wants the same amount of money to stay in the economy. And so you have to purchase something of equal or greater value, and it has to be new to you. So if you're going to buy something before selling what you have, sometimes it makes sense. And so about 12 or 13 years ago, the IRS came out and said, we understand that may happen. Here's how we want it done. So a reverse exchange is done through a mechanism that the IRS calls a parking arrangement. So either the property that someone's buying or the property that they're selling, prior to closing on the first transaction in buying that new property, you take the title either to, again, the property that's being bought, which is most of the time what happens, or occasionally the property that you're going to sell, and you put that in a special purpose entity and you park it. So technically you're not on title, or the seller isn't on title. However, they're in full control, and there's a 60-page legal document that assigns all the rights to the exchanger. So functionally, they're the owner. There's a lease for $0.0 that's created. There's a promissory note, usually for $0.0 that's created, and a number of other things like that. They have signing authority, so on and so forth. So when they go buy this property, instead of buying it, under my name, Brandon Burns, it would be bought under a special purpose entity. And if I was the exchanger, then I would have all the rights and responsibilities and effectively be the owner, but my name wouldn't be on title. Then I would go sell what I have. And once I sold what I have, then the property that has been parked, the 1031 exchange company changes how vesting is held over to how it should be. If it's me personally, my personal name, Brandon Burns, then I can move forward, and I haven't had to, worry about trying to rush into a crowded market and find my perfect replacement property 45 days after I have a buyer close on what I'm selling. So that's why it's a little bit more complex. There's a lot more title work. There's a lot more legal work, right? With a normal 1031 exchange, the reason that it's so cheap is because the paperwork is a little bit boilerplate, right? So we make sure that things are compliant, but we're certainly not drafting custom leases. We're not drafting custom promissory notes. And with a reverse exchange, you need to do that. So there's just more, there's a lot of custom work that goes into that. For a normal or forward exchange, we charge about $1,200 all in. For a reverse exchange, it's about $8,000. So I was on the phone earlier with a title company, a really good title. The title company you use on a reverse exchange matters. So if somebody's doing or contemplating a reverse exchange, let me know. But they called me because it was a different 1031 exchange company, and they had set things up kind of oddly, and there were some hiccups that were going to happen, and the title company, because they were really good, was able to kind of get in front of that before it turned into a disaster. So kind of having really experienced teams to help you with that can really make a difference.
That's really well described. Is it the same? So I think about the same timelines then when I'm doing a reverse exchange. So we purchased that property, and then are we back on timeline for me to do the sell on the other side?
Kind of. So,
Okay.
so the two timelines, right? So once in a typical or forward exchange, when you sell, you have 45 days to identify, write down a number of properties you may or may not buy, and then 180 days to close. With a reverse exchange, the 45-day deadline goes away, right? You've closed on that replacement property. So you've clearly identified it, not only identified it, but you've closed on it, right? So the 45-day deadline essentially goes away. The 180-day deadline, the IRS would still like you to do it within 180 days, sell your property within 180 days. However, if it's going to take longer than 180 days, it's simply called a non-safe harbor reverse. So if you do it within 180 days, it's called a safe harbor reverse exchange. If it takes you longer, then it's called a non-safe harbor reverse exchange. And there have been a couple of times, I believe 3, that the IRS has challenged reverse exchanges that took significant amounts of time, multiple years, and they have lost so far. So, if somebody's contemplating, they're really worried about timelines, that's where reverse, can be more powerful, even though it is a little bit more expensive and a little bit more complex. But your 45-day deadline goes away. And if it ends up taking longer than 180 days, again, not ideal, but unless someone is the unluckiest son of a gun in the world, and they happen to be the first one in the history of ever that had a non-safe harbor reverse exchange disallowed, then they're going to be okay. So there's a very, very minute risk. Certainly somebody could be the first person in the history of ever to have a non-safe harbor reverse exchange get disallowed, but to date, that has never happened. So,
that's fascinating.
99.8% safe.
Pretty good. We'll take the odds. That's fascinating. So then really the only consideration there in that scenario for the investor is, do I have the capital to execute a transaction of that nature, right? That's the only really thing for me to kind of contemplate. If not, I'm getting a little bit of leash here in terms of timeline. That's very interesting. I was not aware of that.
Yeah. And I'd say, so we do about 3 or 4 a month. I don't really advertise reverse exchanges, but they They just come.
Yeah.
And like I said, we do about 3 or 4 a month. And one of the things that I see pretty consistently is about half of people have the ability to write a check and take down that property. The other half don't.
Yeah.
Good for the half that do, right?
Yeah.
You know, again, I'm an investor. I wouldn't have the cash to just stroke a check, buy a property, and then figure it out. So there are some lenders out there, but they again, it's a little bit complex. The last one had a lender and they cross collateralized a couple of other properties that the exchanger had. I think the one before that, they didn't. So the cost of the loan was a little bit higher. So, these are kind of custom situations and they can vary depending on the person, but there's capital out there, again, just a little bit higher deal cost, right? So, if doing a reverse exchange costs you 15 or 20,000 extra interest, costs you, $5,000 or $6,000 more in, legal and title exchange fees, you're looking at 20 or 25,000 all in to absolutely remove that risk.
Mm-hmm.
That's a bigger number,
Mm-hmm.
but often it's not a big number compared to the tax difference, right? So if you're like, okay, well, this thing is going to cost me, 20 grand all in, including, having to get a loan, but I don't have to worry about paying $700,000, $800,000, $900,000 in taxes, and I can fully remove that risk. That's when it really becomes powerful.
And oh, by the way, I'm probably finding something that I really, really like.
Yeah.
And then that ultimately for us, as we watch investors behave, becomes their ultimate concern is they want to own things they like and they want to own things they believe in from an economic and an appreciation perspective. And if they can lock that in immediately, all the better. You mentioned, the audit component of this, like never happened before, from this perspective of being audited against that sort of expanded timeline. Speaking of something that hasn't happened before legislatively, is we still haven't eliminated 1031 exchange, even though it gets threatened every 5 minutes. And almost
right.
my clients talk to me about the risk of this going away. I'm sure you have a viewpoint. So open floor, is 1031 ever going away?
So when Biden got elected, right, it was 2020. And in his first State of the Union address, he said 1031 exchanges are going to be eliminated over 500,000. That was, it's like you said, it's been bandied about a number of times throughout the years. That was, I think, the strongest and most aggressive that someone has come. And so at the time, it's very worrisome for me because that's my life, my world.
Mm-hmm.
Facilitate, often more than 50 exchanges a month. And so if that, what does that mean over 500,000? Is that per person, per deal, per year?
Mm-hmm.
Who knows, right? There's no other clarification or language.
Mm-hmm.
Clearly didn't happen. It's back on the table now that it's next election cycle. I think normally the Democratic Party wants to do some good, and they need money to do that, right? They want to say, hey, how do we forgive student loans? How do we do, this system or policy? How do we help these people? And then the other side of that coin is, where does the money come from? And so, 1031 tends to be on the table every election cycle, from at least from a conversation perspective. Now, the best and the worst thing about the United States, in my opinion, the best thing is if the rich and powerful want to do something, it's open to the rest of us, right? Section 1031 has been part of the tax code since 1918. I wasn't alive in 1918, but I'm sure that it was put there by people who were in power who wanted to be able to switch in and out of properties like we discussed without having that tax hit. So now that becomes available to all of us. The downside of that is that there's a big machine from a lobbyist perspective, a lot of money that goes behind some of these significant policy decisions. And I think most of the time the lobbyists aren't good, but in this instance, I think there's enough money of lobbyists behind the real estate world and the tax world that are going to keep the 1031 exchange from being removed. However, that being said, I do not have a crystal ball. So what I feel and what I would tell my closest friends or family who had property and who are worried about the 1031 exchange going away, I would tell them, if you're comfortable holding on to this property for the next decade, then you don't need to worry about it. If you're not comfortable holding on to it for at least a couple of years, then you need to make a move while we're certain that the 1031 exchange is still available. Because under Biden's proposed tax plan, he's talking about taking the long-term capital gain from 15% to 44%. And especially if you're in a state where there's state taxes, putting that on top, you're well over 50%. California, once you include a 44% proposed capital gain tax, plus California state tax, plus the net investment income tax of 3.8, plus depreciation recapture, you're looking at over 60% in total taxes. So that's ridiculous, right? So that's just going to slow things down, kill the market. So if somebody wants to make a move, now's the moment, right? Where summertime is a better time to make a move traditionally than the holidays. Before an election is typically a better time to make a move than after an election. We don't know what's going to happen long term. Will the 1031 exchange get eliminated? I think it's unlikely, but it's possible. Will the capital gain tax go to 44%? It's possible. Depends on what happens in the election. So I just believe in life, if you can remove uncertainty and take risk off the table, that often can be a really good move.
Yeah, it's good advice, and we sort of give the same in that. Well, we have the advantage of these things right now. We know we have them today, so let's utilize them. Do I know I'm going to have in the future? No. But I also know that the tax code is a giant, huge book. Very little of it is about paying tax. Most of it's about not paying tax. So
that's a great point.
We'll find a way down the road. This might not be it. If they eliminate 1031, it might be something else. But we will find a way because it's in that big, giant code book. And we'll do it one way or the other. So it'll be very interesting. Sort of see what happened. And just a final point on that. You mentioned the lobbying efforts, and I've definitely participated in writing to, my representatives about it. The unintended consequence here is people like yourself and me, for that matter, who, because of 1031 exchange, have earned income and we pay tax against it. That goes away, right? And I think folks would be really surprised at how little this market's going to drag down, right? And so the brokers associated with transactions will slow. Is there really tax revenue here if you eliminate 1031 exchange? Not as much as you think there is. I forget who did the study. Was it Deloitte who did a study on that? It actually had a negative tax impact if you eliminated 1031 exchange.
They did a study, and it was less taxes collected by the federal government. And we're also seeing that there's a little bit of a case study in Los Angeles where I think it was a year, 15 months ago or so, they implemented what they call the mansion tax. So single family homes over a certain amount got hit with an additional tax. And instead of the same amount of volume happening and money falling from the sky for the city of Los Angeles to do whatever they were looking to do. And I think they wanted to do good things with that money. But instead of there just being this massive, wheelbarrow load of money dumped on them, instead, it just dried up. And people didn't transact. And so the amount of money that they actually received was significantly less. So not only do we have the Deloitte study that shows that, but we have that kind of interesting case study, even though it's a little bit different. The general principles are the same. And unfortunately, the result is the same as the Deloitte study prediction.
And what you hear in the media over here, and then the reality of what actually happens with the dollars and cents over there. So if the government's not getting their money, I find it hard to believe they're going to make a move. Do that. Probably do something else. So I'm a little bit more worried about the cap gains. I'm a little bit more worried about, we talk a lot about step up basis on our side as sort of the ultimate end game here for exchange, basis, step up, pass to heirs. Everyone's happy. That That is threatened because I can't prevent people from dying. I mean, we can prevent people from transacting. That we can do, but we all have a time clock that we're on.
Right.
So that one makes me a little bit more nervous that we see that, and then we have to again take out our big textbook and see if we can find ways to outwork that one. That'll be a little bit tougher. What am I not asking you that you want to share with us? This is awesome. By the way, your knowledge is very deep. Oh, I know what I wanted to ask you about. You mentioned the designation that you hold inside of the QI, Qualified Intermediary 1031 exchange space. Can you talk about that a little bit more, and in conjunction with that, some of the regulation or lack thereof that we have in this space? The QI matters, and who your QI really matters. Can you go into detail about that?
For sure. So one of the things that I find really interesting, and that I hope I can be a part of a better solution. The different parts of the financial world have different types of regulations, different regulators, right? So the insurance industry has a little bit different regulation than the securities industry, which has a little bit different regulation than the real estate industry, kind of so on and so forth. In the 1031 exchange industry, as a group, we approached the Treasury Department, I think it was about 14 or 15 years ago, and said, we really want to lobby and ask for a specific regulator just for us. And the Treasury Department said, you're not big enough. There's only 119 1031 exchange accommodators in the United States. And they said, that's just not enough for us to allocate resources. So there's not a single regulator like there is for the securities industry over the 1031 exchange space. So what ends up happening is the quality of a qualified intermediary can vary fairly drastically. And it's really going to depend on the background, right? So, if somebody comes from a background of law, they're going to be maybe really strong in some legal things, but maybe not as strong on the investment side, right? And my firm, I come from a background of investing. I have attorneys on staff, and also have some people with an escrow background. But when it comes to understanding title insurance, right? That's where we really lean on the title insurance providers, especially when it comes to, more complicated transactions like a reverse exchange, right? So each company is going to be a little bit different. And, there's some really big ones out there. There's two that are publicly traded. However, it's the 1031 exchange for the publicly traded ones. It's not their main business. So title insurance is the most profitable insurance in the world, because with most types of insurance, you look forward, right? Life, health, auto. What's the likelihood that something's going to happen? With title insurance, you look at the past. And with the data that we have today, title insurance tends to be over 99% accurate. I read the public filings for these publicly traded title insurance companies, and I think for the past year or two, it was between 99.7 and 99.8% correct. So they only have about 20 to 30% of 1%, or 20 or 30 basis points payout, because they've got this great data that they can look at. And with AI and the data things that we have now, it can be really accurate. So if you're running those publicly traded companies and you've got a Harvard MBA, do you allocate more resources towards your 99.8% profit product, or do you allocate more resources towards your $1,200 profit, $1,200 product? So in those larger companies, they tend to allocate the resources away from the 1031 exchange company, and they don't want the 1031 exchange company to mess with their 99.8% profit business. So they're very strict and say, hey, you need to move the exchanger from point A to point B, or have them pay taxes. And that's just, such a different approach than a consultative approach. Certainly I understand where they're coming from. But the qualified intermediary that you use, I think, can make such a difference. My goal over the next few years is to be a part of creating a self-regulatory body that comes in and trying to work through what that looks like and say, is there an accreditation that's done where, somebody comes in and audits you really consistently, and what does that look like? And so, I'm frankly excited and grateful that I can kind of be part of that, right? And that's one of the reasons that I enjoy and why, I've moved from, more profitable parts of real estate and more in the investment side, more to the kind of processing side of real estate, is because that, there's just, I think, such a great opportunity here, and I can be really involved in that. And that's something that really kind of gets me excited and gets me out of bed.
Making note here, start title insurance company. Sounds like a good idea. Something I'll do this afternoon. No, your points are really well, and I love that you're part of this, because it's rare that I think I've ever seen an industry walk up to the government and say, regulate us.
Right.
And it's a really good thing. If you want to have fun, I'm sure you've done this before. Go on Bigger Pockets, search for the qualified intermediary horror stories. They are out there and they are real, and there's nothing preventing that from happening at all. And that's very scary to sort of think about, that your proceeds, who knows where they are, right? If you don't have a great QI who's properly managing that money, they might be buying somebody a Ferrari. Like you just don't know. And that's very frightening for me to think about from the financial space and the way that we're regulated and regulated harshly. And it's good. I want to be that way, because this is, we got a great responsibility that we're taking, and you guys do too. And it's awesome that I think a self-regulating arm would be great.
How cool would that be, right? So there's some things that we're continuing to work through, but I really hope and believe in 24 months we can have something that says, and I can be a part of that effort, right?
Yeah.
So that would be something that I could be proud of for the rest of my life.
Oh, absolutely. It'd be a great thing for investors. Brandon, this has been awesome. Thank you. And you are a wealth of knowledge in this space. That's for sure. You've earned that certification like 16 times over just in this conversation.
There's one other thing I think is worth mentioning. Do we have another couple of minutes?
Absolutely.
So one of the things that I think is really interesting, right? So our headquarters are in San Diego, Southern California. Got an office in Dallas and a small office in Miami. But one of the things that I'm kind of consistently seeing is, we just finished a really great market cycle, right? Mm-hmm. And it was hard to lose money in real estate in this last market cycle. You literally had to work at losing money almost. Yes. Happened, but it wasn't common. I think we're entering a different points, right? Up until now, most where all risk has been rewarded. I don't think that's going to be true going forward. So, as a specific example, there was someone that I know who inherited a property as a single family home on the East Coast, and his family bought it a long time ago. And in the last 8 or 10 years, it really hadn't grown in value. It needed a lot of capital expenditures, a lot of CapEx. The same tenants were there because it's kind of run down. They not only weren't able to raise the rent, but they actually kind of decreased rent over time because the tenant was taking care of a lot of the maintenance. And so in the last 8 years, this particular person, their real estate asset that they inherited grew by zero. The income grew by zero. The value grew by zero. And I think that's a travesty, right? Yeah. So, especially people that own rental properties, a lot of times they have tenants that they really like, and good tenants. And so these good tenants, it's hard to go to somebody that you like, that that is you have a relationship with, and say, hey, the market's up 10%, over the last 3 years, we need to raise your rent by 30%. And in some places you can't even do that, like Southern California with some of the regulations in place. So what ends up happening sometimes are people have assets that they're not maximizing the value. Mm-hmm. Maybe when they bought it right, but based on the value today, they're only earning 1.5% to 2.5% on the gross value of their equity, which is less than a CD. Mm-hmm. So if someone has rental real estate and they haven't raised rents or done a 1031 exchange in the past 4 or 5 years, I would really encourage them to, sit down with you or at least take a really hard look at 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 the value of their property, the income being received, and make sure that they're not just getting the travesty of 1.5%, less than a CD.
Mm-hmm.
And in that situation, if you don't reposition that asset, or whether it's repositioning through a 1031 exchange into another piece of real estate, whether it's selling that and using that to pay off debt or start a business or invest in whatever else you're doing, not only can you go from earning basically nothing, but you can have significant events, capital events that wipe out a lot of value. So a very specific example, and then I'll kind of quit rambling. But
keep going.
I know
keep going, because I'm gonna jump on my soapbox when you're done. At this point, keep going.
Somebody had a threeplex that I know, and she was recently widowed, and she came to me and she's like, Brandon, hey, I've got the best tenants in the world. I said, oh, that's so great. So happy for you. It's good to have things go right for you. She's like, yeah, they even paid rent early this month. I said, oh, wow, that's great. How much did they pay you? And she told me this very ridiculous small amount. She'd owned the property for 10 years. She never had the tenants. She never raised the tenants' rent in 10 years. And so I'm like, oh my gosh, you have a young son. I know you want to send him to private school, and it's, tough financially to do that. You need to be earning 3 times on your asset, and you should probably sell it and buy something on the same street even, but have something where you don't have these surprise repairs coming. You don't have tenants that you haven't raised rents on in 10 years. Have you even been in these units the last 10 years? She hadn't. Who knows? Did they paint the walls purple? Was the carpet torn up by dogs? Who knows, right? And so, but she told me, she's like, I know you're right. She's like, but I'm very comfortable with what I have. I like what I have. That's fine. She said, I'm going to raise the rent $100. I said, hey, you should do whatever you're comfortable with.
Yeah.
She came to me 6 months later and said, Brandon, I messed up. What does that mean? She said, the tenant in the largest unit came to me, said they needed new windows. I just got a bid. It was $36,000. I need to take out she's like, I don't have $36,000. I need to take out a loan against the property to go in and do the repairs. And just doing the math on the income she was receiving versus the repairs that needed to be done, it wiped out over 2 years of income based on her current income situation. And so, for my friend specifically, who is recently a single mother with a younger child who's trying to make her way forward in life, by being unaware and uneducated of what her options were, it was negatively changing her life dramatically. And my hope is that, the people watching this will at a minimum say, let's be intentional, and aware and educated, and make whatever decision is right for them, but be aware there's other decisions to be made.
Do you have a name for that metric? Because it's not cash on cash, but cash over value. Someone came up with a name for this before. I think we need a name for it, because we just pound away at this point over and over again and say your true current yield is X. And it right. makes people kind of stop in their tracks and go, whoa, how'd that happen? Well, real estate is a business. Real estate is also risky. And you need to manage this property. If you're treating it, and your example is very typical of what we hear too, folks treating it as a passive investment. It isn't, because there's no one managing it. You're the manager. It's active. Right. And so if you're treating it like it's passive, maybe you do need something that's passive. And that's sort of where we step in and help folks out. But then when they start looking at the economics of those options, they go, oh, yeah, that is actually better if I do nothing and get that number than trying to be active and getting this number, which is lower. Right. That makes a lot of sense to me. I get it. But they'd never gone through money. Your point is really well taken, and one we're going to cut out of here, is being intentional and managing and just sitting down. I mean, this is a once a year activity, maybe, right? It could be with me, a CPA, whoever it is, and saying, well, what am I really earning on the value of the assets that I have? Mm-hmm. It's really important. And then we watch people's brains start to change, and they're like, oh, okay, this is how I should manage my assets. Yeah, now we're going. And we end up turning a lot of these folks start thinking more like pension and endowment fund managers, then they think like real estate investors. And that freaks them out when I tell them that. Like, this is where you're headed to. This sort of weird world you don't want to go to, but that's where you are, right? You're here and you're managing, you're stewards of these assets. Eventually, you're going to have liabilities for either yourself or the people in your life. You're a pension or endowment fund manager. That's who you are now. Congratulations. It's an earned position. You have enough money to think about that. That's great.
The endowment of your life, right? I think, if we look at previous generations, they worked for the same company, they got a gold watch, they got a pension. And today that's just not the case. I'll be 41 this summer, and I've had some of those same conversations with my dad over time, and I think our generation, because that, or maybe I'd say a couple of generations around us, because that we have access to more data and there's more connectivity, that creates a lot of opportunity, but it also increases what's the right term? Like, not indecision. That's not the right thing that I'm thinking of, but it creates optionality. Has two sides, right? Everything is two sides of the same coin, and having the ability to have access to more information, have more options, it also takes away potentially some security. And I think one of the only ways to provide that security is to own real things, right? Whether that's a business, whether that's real estate, because you've got the tax advantage. On real estate, for example, you've got the tax advantage, you've got the growth, you've got income, you've got a number of different levers you can kind of pull. And that's so dramatic, right? Being able to trade in and out of assets, reposition, maximize the value here, swap it into something else where you can maximize the value without having to give a big piece to the government. Otherwise, how do you save your way to retirement? It's so difficult. It's so difficult, right?
Yeah, it's nearly impossible at this point, and we sort of pound away. This is more of my kids that I'm hitting up as they age, is like, own assets. And they're like, what's an asset? Like, an asset is something you own that pays you, right? I go Robert Kiyosaki on them, right? I'm like, it's that simple, right? And so if you own enough of those, they're paying you, that'll sort itself out, right? Keep buying assets and good assets, and you'll be just fine. But we need to know what they're paying us, and we'll come up with I know there's a metric for it. I'm gonna find it. We're gonna put a name on this thing, right? This cash on value.
I love it. You should put a name on it. You should patent that name, and
there you go.
And go drape it on some big buildings in some big cities.
I might do that. That might be the first billboard we do.
I love it.
Brandon, this has been way more than I could have imagined. This has been absolutely awesome. Where is the best place for folks to find you?
Yeah. So I'm pretty easy to get a hold of. I don't have a wife, a kid, a dog. 1031 exchanges is my whole life. Real estate tax is my whole life. They email me. So Brandon at Vanguard1031x.com. And also let me give my cell phone number here. Cell phone number is 214-280-0908. Or I'm also on LinkedIn, Instagram, Facebook, really visible out there. Again, Brandon Burns. If you go into Instagram or LinkedIn and type in Brandon the 1031 guy, I'm the one that pops up. So yeah, any questions that people have, my main goal in life is to make sure people have the right data to make the right decisions. And again, often I'm jealous of people in your position that, truly get to be partners with them along the way, while I just kind of sit back and make sure everyone has the right information so that they can make the right decisions. But I still really do enjoy making sure people are aware of things.
Well, you're providing a tremendous amount of value in doing this role that you have and doing it well. And thank you for doing that. And thank you for joining us. I really appreciate it.
Yeah, I'm glad to be here. This is super great.
And thank you all for listening. Until next time, take care.